One of my favorite economists, Mohamed Al-Arian, just said on CNBC and Bloomberg last week that he thinks that the Federal Reserve looks at data that is too backward looking and that the Federal Reserve is too data dependent, relying on that backward looking data in order to make their interest rate decisions. He thinks that the data for CPI, for instance, is very lagged, and I kind of agree with him, especially for the shelter component of the CPI inflation. It's almost like driving on a curvy road, but looking backward. Mohamed Al-Arian also thinks that the Fed's inflation target of 2% is outdated, especially in a structurally higher inflation environment that we are now due to onshoring. And I do agree with him. I think that the Fed should stop raising rates. We are seeing the effects of the Fed's hawkish language in the rapid rise of 10-year bond yields that just crossed over 5% shortly this morning. The rapid rise in 10-year bond yields has been hurting stocks for weeks, and when the 10-year bond yield hit over 5% this morning, it weighed on the stock market and stocks sold off. However, once Bill Ackman, who put on a bet shorting bonds a little over 2 months ago, saying that he's covering his shorts and he thinks that people and investors should be buying bonds again as almost a hedge against geopolitical risk, then bond yields started going down. Bonds prices started going up, and that actually caused the stock market to do a little bit better later on in the morning. Hopefully that comment by Bill Ackman marked the top in 10-year treasury yields. In my opinion, I'm not sure, maybe in the short term, but this is good news in the short term for the stock market, likely propelling the stock market higher into the end of the year.